that started. And for some reason, hey, we didn't even start the recording. Wonderful. A syndicate talk is all about providing that education, from human resources to marketing, sales, business structure, financial, accounting, bookkeeping, safety, IT. All of these aspects are areas that business owners, managers, and leaders must be aware of, must be educated on, or must find the resources and the people to support them in those areas. Today, we brought together two of our syndicate members, Jeff Knox and Komal Sandhu, to discuss financial education and financial literacy, and they're going to work on fundamental tools. We like to break things down into simplistic fashions. 2 things, 3 things, 4 things, 5 things. The fundamentals, the quintessential building blocks, and we're going to work through those between Jeff and Komal today. They are both experts in their field. They are both financial advisors and have experience. They've both got specializations within that field as well, and they're looking to share the hard work and dedication that goes into being a professional in their profession to once more help to educate you and grow yourself and your businesses. Komal, Jeff, thank you for coming on board. Welcome to this. And Jeff, we'll start with you. If you can get a short little bit about yourself, of course, and what you're going to discuss today. Komal, we'll come to you next. And then, ladies and gentlemen, let's get started.
Okay, well, thanks, Mitch. I appreciate that. I didn't think I was going first. We go through the 1 to 4. That's why I picked 3 and 4, so Komal could go first.
Just the introduction. That's why I'm going to get you to introduce yourself. I'll get Komal to talk, and then she can start talking, and you can put yourself back on mute.
Awesome. Sounds great. Well, thanks, everybody. I appreciate everybody coming down here. It's, well, come down on Zoom. A little bit about myself. My name is Jeff Knox. I come from a construction background before I actually got into the financial field. So I kind of specialize in businesses because it's, my wife and I have owned an electrical company for quite a few years, and found that that's where we can actually add the value from the business side, because we know what business owners go through and where we can help them. And it's kind of crazy or fortuitous, I guess, that these times are happening right now. So there's, and you know, Komal would agree, there's a lot of ways that we can help families and businesses get through this time. And that's why I'm really appreciative to be a part of Cyndicate, because we can actually leverage everybody in this group, and by propelling other people forward, we can bring ourselves forward too. So I'm passed on to Komal.
Hello, everyone. This is me, Komal. Thank you so much for tuning in, and thank you, Mitch, for giving this opportunity to be able to come in front of a lot of business owners and be able to some help for everyone. And thank you, Jeff, for coordinating everything and dividing our task together, and be able to present as much information as we can today. So, Mitch, just let me know if I can start the presentation, or how much time do I have, so that I can make sure I'm able to, I have 20 minutes. Okay, there you go. Okay. All right, ladies and gentlemen, let's get ready. I'm going to share my screen up here. Screen 1. No. Yeah, screen 1. Share. All right. So, a little bit of my background. Like, I only come from banking background, so this is all I know. So I have transitioned from a day-to-day banking representative to an independent consultant 2.5 years ago, and started working with individuals as well as business owners in the capacity of helping them as much as I can. So since I have only 20 minutes, so I'm just going to quickly dive in so that I can cover as much information as I can. And I don't know how to run this. Okay, there you go. Okay, so these are the few topics that I will be covering in what financial planning is. First of all, what do you mean by financial planning is actually it's all about setting up the basic principles or disciplines in your life so that you can easily walk on the path of building wealth for yourself. And a little bit about IG Wealth Management. We have been in the business for the last 90 years and serving over 1 million clients. We have 2,000 consultant practices across Canada, and my practice is one of them, and managing over $80 billion assets under management. this is how we are uniquely positioned in the marketplace, as we are part of the Power Financial Corporation. Great West Life, as many people are aware, are also our sister company, and IGM, and that's where we are here. And these are the world-class partners that we work with in terms of providing best investment solutions. And these are the major companies that we are a part of, and they are under our shelf. So some of the aspects that I help most of my clients with is 6 different aspects of their life cycle, along with the tax efficient strategies, which is more prettily or picturestically defined here in this map, where it's a roadmap for achieving long-term financial goal. Sharing your wealth, managing your cash flow, preparing for unexpected, planning for major expenditures, maximizing your business success, and optimizing your retirement. I'll leave the 2 different, some of the aspects to Jeff to continue with it. And but first of all, we need to understand which business life cycle we are at. Are we at a startup phase, growth and expansion, or we are heading toward maturity or succession and succession planning? Oh, hold on. I'm going to minimize the screen. Succession or transition. So if you are a startup, your next phase is growth and expansion. And these are the 4 or 5 bullet points that you need to look into in order to proceed from one level to the another level. If you're a startup, then you are moving to growth and expansion. If you're growth and expansion, then you're moving to a maturity state. And these are the aspects that you should be looking into at this particular point to prepare you for the next phase, next life cycle. Some of the definitions that you need to know in today's market, which is lingering all over the social media and different media channels, is like, what is market correction? What do you mean by bear market? And all of that. So I'm just going to quickly go over what does market correction means. It means that the stock market have declined by 10%. This exact situation happened in the last quarter of 2018 when the market dropped by 10%. What is the bear market? When the stock market declined by 20%. Right now we are existing in the 20%. We are existing in the bear market. What happens is on March 12th, 2020, the Dow Jones declared that the end of a bull market, and we entered into a bear market because the market declined by 20%. At 25,553 points. Now, what do you mean by market crash? And all of the social media channels and different investment gurus are talking about when is the next crash, are we in the next crash, and stuff like that. So when the stock market declines by 35 to 60% and it lasts for more than 3 to 6 months, that's when the situation when we can say that the market is that the stock market has crashed. So we are not there, but we are very, very close if the market keeps on going down the way it is going right now. Recession. The next topic is why are we in recession? So when the economy declines for straight 6 months or higher, then we can say that recession has hit in. So right now we are not there. We are only in the three months timeline. If it continues more than another 3 months or so, then after that we can say that yes, we have hit the recession and we are in recession. And if that recession continues for more than 2 years and the country's GDP decline more than 10%, that's when the situation is that the economy has got into depression. One of the words that we need to be very, very cognizant and very, very careful about is, which could be lingering in the marketplace, is the black swan. So the black swan is the word when we say that we cannot predict anything, and whatever is happening during that time has massive economic consequences. So right now, all of the situations, for example, even 9/11, a situation that happened in September in 2000, I forgot about the year, but whenever that happened, then at that point of time, it was considered that we're heading into a black swan, but we were not. So some of the things that you need also look into the market volatility, and these are the incidents that happen over the years. how market have performed. So which is equal to the 26% of the times when the market was down. So that means the 74% of the times have the stock market have been in the upward trend. So this is the duration. For example, the longest duration that happened when the market was in recession at that point of time is in September 2000, where the stock market declined by -38. Even in 2008, the market only declined for a duration of only 9 months, although the stock market declined by 43% or so. So we still have a lot of chances that it can recover back, and it's recovering slowly and steadily, but there is still second wave of pandemic or crisis that we can expect, and the next 3 months can be most crucial, which I will talk about what you can do in the next 3 months. And this is the recovery cycle of the 12 months decline in the years when they have the major drop down in the stock market, and consecutive following 12 months how the market have regained back and bounced back even more higher than it was even declined, and it continues to grow for next 5 years. So when we look into the long-term perspective, this is what we should be looking into, because history repeats itself. What are the different sources of wealth that you can create as a business owner? One is the value of your business. The other one is your corporate investments, and absolutely your personal investments. So the 5 principles that you should be looking into at this point of time is definitely take advantage of your time. Use time as to your advantage. Right now, you have all the time in the world that you should be working on your business before you work in your business. Diversify your portfolio more than diversifying your institutions. I know that people have different banking and bank with different institutions, and they have 250,000 somewhere else and 300,000 somewhere else, and like they're nowhere considered as a high net worth client. So diversification of portfolio is important, but not the diversification. Shrink your diversification of institutions. Avoid emotional decisions at this point of time. This is not the right time to make any kind of emotional decisions at this moment, to sell off your investments and put it into cash investments. No, rather you should be looking into getting in more research about if you're doing what you're doing is the right decision to do, and maintain long-term focus. Like whatever the presentation you will see, I'm only focusing on the long-term vision from 3 months to 3 years to 30 years and moving forward, and definitely stay invested. Do not touch just like you're not touching anything without touching the sanitizer. Similarly, do not touch your investments at this moment. So what, as a business owner, that you should be looking into right now is how you can increase the value of your business, how you can make your business more attractive. And can you make your business to a point that is sellable in the market at some point? Which is a part of what value, which is a part of value of your business. And 6 different aspects that you should be looking into: making sure that you are able to have recurring revenue for the business. Get to know your potential buyers. Who are going to be your potential buyers? Who are your potential buyers? Diversity of client and supplier. If your business is relying on 1 or 2 suppliers, find out a way that you can diversify your supplier chain into more suppliers, or in-house suppliers, or diversify your clientele into where you're taking care of one segment of clientele, focus on like 1 or 2 more. Make your business as visible as possible. And secondly is sit down with your accountant as well as your advisor to have clarity of your financial statements. And management succession plan is another topic conversation, but in short, I can say that find a way that what are the things that you can delegate to somebody and create a team of people so that you can step away from the business and can focus on the business development or the other life stage of your the next life stage of your business. The other passive income incomes that you can also create as a part of your overall wealth is through these sources, which is interest, rental, net rental income, royalties, dividends, foreign investment income, taxable. And don't worry about the 2018 tax rules and how the tax rules applies, because I just took this slide from the perspective of this particular presentation. Also, if you're depending upon the different life stages, you should, like, if you're taking dividends now, then there could be a situation you are either at a startup phase or at the growth expansion phase of your practice, of your business. So why do you think that the CEOs and the major directors and vice presidents have like highest salaries? Because salary is a tax deductible expense, and it is more profitable, it is a much better source of tax saving strategy when you are moving towards maturity or succession phase. So you gotta look into that aspect moving forward. Do you really want to stay as a dividend pay yourself as a dividend, or start taking salary? And because there are a lot of other benefits in the long term, which I will explain it to you. What you can do in next 3 months is very, very crucial. First of all, is negotiate all your expenses with every provider you have. Bet your business expenses, bet your insurances, bet your your utilities or anything like that. Negotiate, because right now the customer retention is the key for every business. And just like you are trying to retain your clients as much as you can, similarly all other businesses are trying to retain their customers as well, and they will be happy to give you negotiated prices. So negotiate with them. Allocate percentages to your income, expenses, and savings. Instead of giving dollar value to your investments or your expenses, give it a percentages. Start with 90-10. 10% is the way that you should start saving money right now. It doesn't matter how much income you're making, even you're making $1,000 to making $10,000 to making $3,000 to making $30,000. Start saving 10% of your income right now, and rely on your major lifestyle expenses or debt payments into 90%, and slowly and steadily move from 80-20 to 70-30%. These are the different strategies that I use with my clients, depending on how they are, depending on their situation, but I just thought to put it here. And prepare yourself for not only the next 3 months, because next 3 months are going to be the most crucial, but how you want to be in the next 3 years to next 30 years. For example, if I say, like, if I am a part of a syndicate organization, I don't want to see myself as a part of syndicate organization and in that capacity, like a member of it. I rather look into being a shareholder of syndicate organization, or probably own one piece of syndicate organization in the next, because we all have the capacity and the ability to have our own channels and own clientele, and can own a piece of syndicate organization in the coming 10 years or 30 years or so. So that's why it's important to work on your business at this moment more than working in your business. What does your future look like as a business owner? Okay, so if we are thinking that the government will help us to establish our businesses, or make it run the businesses in the coming time, I think we should start looking towards inside ourselves, what are the strategies that we can use as a business owner. The one long-term strategy that you should be looking into, individual pension plans. This is the RRSP look like, right? We always say, like, you know what, I'm a business owner, I don't need to save any money in the RRSPs. Fine, I understand that. But this is the room it looks like for RRSP when you are depending on the contribution room. But when you look into IPP, it opens up a bigger mouth to accommodate, to create a room for your IPP. What is IPP? Is an individual pension plan. It's like a defined benefit pension plan, which is basically specifically designed for business owners or key employees of incorporated companies. And they have like special funding rules for designated plans, depending on, but it's a little bit cost driven in the beginning, but once it's set up, it definitely solves a lot of issues in terms of providing you a definite pension over the period of time. And why IPP? Because it provides an annual lifetime retirement benefit at the age of 65, and there are a lot of other and this is analyzed every year, and there are a lot of other aspects that goes deeper, but I don't want to go in too much because I have limited time. But who is the candidate for that? Any person, any business owner who is 40 years plus and taking a salary of not a dividend but a salary of 100,000 plus. So that's why it's important when you are moving towards from one life stage of a business to another stage, right? Options at the retirement, and this is the these are the options. I'm not sure how cognizant I am about my time. Please notify me. Am I on time? 5 more minutes? Okay, thank you. Okay, so Jeff will continue. I'm going to show here. I'll let Jeff to continue about the importance of insurance and insurance planning for corporations. But this is how the normal cycle looks like, that you are paying, you're making income, you're paying taxes and expenses, and you're saving out of that. And that's how your net estates can look like. But as you follow the financial plan, we have the ability to calculate detailed cash flow savings taxes over the next 41 years. And if, let's just say, for example, I just took this slide from an example, but if you're doing what you're doing and you've been able to have a net estate of this much $6.7 million with no planning, but we have the ability that which is called Monte Carlo analysis, through which we can see different scenarios and make different presumptions and predictions about what your life cycle will look like and how much are you closer to your wealth planning and succession planning of your business as well as personal life. So I'm not going to go over too much, as this exemption can also, the capital gain exemption can also change based on how the taxation new rules going to come up. So if you look into that perspective of like continuing whatever it is, Canadian capital gain exemption, plus you add individual pension plan, change a little bit, make a little bit of shift on your portfolio and add insurance to it, you not only reduce taxes from the corporation side, but you decrease your taxes at lower at death, and you increase your net estate over the years. And this is how it can look like if you apply one or two or three of all the strategies in order to have your net estate of taxes. And I have trust. This is me. That this is what. How you can create your financial plan is definitely, I understand what it matters to you, making sure that understanding your current situation, your goals and your objective, and create a holistic plan. And it's not a cookie cutter plan that I help my clients with and then monitor and continue with this. I would like to share this slide with you because this will give you a lot of analysis in terms of if you are in the hands of a good consultant, or does your consultant need a room of improvement, or it's time to have a second opinion, or you should run away from the consultant that you have. So that's all from me, what you can do in terms of your financial planning. I hope I've been able to give you an overview of what your financial planning should look like. And if you have any questions, this is my number and my email. Feel free to reach me out or send me a message up here so that I can answer them accordingly. And I think that's it from me now. I'll move it on to Jeff.
Kamal, thank you very much. From our attendees right now, any questions for a moment for Kamal before we turn over to Jeff? Anything stand out for the moment? All right, Jeff, the floor is yours.
Awesome. Well, thank you very much, Kamal. That was awesome. I know we're just doing an overview, a brief overview for you guys because there's, 20 minutes is not too much time. So let's see how good I am at sharing screens. Actually, for this first part, what I'll do is I'll just talk about it. Let me set my timer there. Actually, I won't know. I'll go when So I wanted to just talk briefly about, the 5 different types of personal insurance. I'm sure everybody is very familiar with life insurance, and life insurance is basically for the people that we leave behind. There's a couple of different types of life insurance. One is term insurance or permanent insurance. And the term insurance is like a temporary, kind of like you're renting. It's for a certain period of time. And then, in most cases, it's 10, 20, or 30 years. Permanent insurance, and I'll give a little example after this on the slide, but I do a lot for business owners. So it's like lifelong protection. You can get a cash value based on a tax-deferred basis. Second area is disability insurance. So disability insurance is, well, when you pass away, it's for the people that you leave behind. Sorry, I just said disability insurance. Meant for the living. So it's meant to replace a portion of your income while you recover. And then critical illness. Critical illness insurance is a lump sum payout in the event certain covered conditions, if you get one of those conditions. And long-term insurance. So taking care of your basic needs in the event that you cannot do it yourself. There is, Kamal and myself, both being brokers, we offer, many different scenarios for what this could look like for many different people. So like Kamal said, it's not a cookie cutter. It's not a cookie cutter for everybody. So we can definitely customize it for you. And the fifth one is just health insurance. So I know a lot of people have, this medical, dental, massage, chiro, etc. And normally it's from your employer, but I've been reaching out to a lot of people, and a lot of people are getting laid off right now. So their health insurance is not being carried forward. So once that 30 days is over, people are going to be out of insurance. So we have some amazing plans that we have access to that we can actually help business owners who may be unemployed or even employees that are unemployed now carry on with their benefits. So I just want to show a quick, this is one of my, oh wow, why can I not share my screen there? Okay, technical difficulties. I cannot share my screen. Okay, well, let's see if that will, can everybody see my screen? Can you see my screen, Kamal? Okay, excellent. Good. Yeah, it's not showing the way I want it to, but that's okay. We'll make do with this. So I just wanted to talk a little bit about one of the strategies, and it's more of a permanent insurance strategy. So as long as everybody can see the screen, the corporate preferred strategy, and this is one of our product providers that we use. So with the corporation, using your universal life policy, and one of the most effective tax ways you can get the shares out of your company. So with a corporation basically, and you can see it right here, purchases the insurance policy, and then you can kind of do the passive investments, you pay the taxes, or you can do through an exempt life policy. And it's nice because your corporation can be buying into this rather than you buying into it. And then the insurance proceeds are paid to the corporation tax-free. And then it's what's set up what's called a capital dividend account. And then, of course, it pays it to your shareholders. So there's different ways, and this, of course, is not for everybody. but it's nice for people that own corporations and that have some cash flow, or maybe even have some money sitting in their corporations right now. So I just wanted to just briefly touch base on that. There's not a whole lot of time to go through this, but definitely you can reach out to myself if you have a corporation, if you're looking at setting up some tax advantage strategies. It's something I can definitely take a look at. And on the back side, here's a couple of reasons why you would put it together for yourself. Determine the amount of insurance you need, and then being able to grow your assets inside your corporation. Supplement your retire cash flow. I know Kamal was talking about that with the IPP, and there is many different strategies to utilize your company. Whether you have a big company or a small company, there's still a lot of tax advantage strategies you can use. So if this solution could be for you, if you're the owner, if you have some passive assets, and of course, everybody is looking at ways to reduce taxes, especially right now. And if you want to supplement your retirement, and then of course, life insurance. I mean, as a corporation, as a business owner, you want to ensure that everything is properly protected, and you're protecting your business and the people that you're leaving behind too. So I will change out of that here. I know that's just quite a quick overview, but my apologies. I'm having technical difficulties here. So let me go back into this one. Can everybody still see my screen? Okay. Well, that's the way the cookie crumbles, I guess. Sometimes it's interesting. Awesome. Okay, so I will just leave a fair bit of time at the end here so we can have more questions. But I just wanted to talk a little bit about our parent company. So I work with a company called World Financial Group, and Aegon is a massive company. Mitch, can you see this screen? Aegon screen? Okay, excellent. Thank you. So Aegon basically acquired us in 2002. They're a huge company. I think they're valued around $1.2 trillion. And when they expanded into the North American economy, they were looking around, and companies like this don't just, build, they actually acquire. So it was nice that they were looking and they acquired us. They saw a lot of value in it. And with World Financial Group, basically we're a broker. So because we don't have any of our own products and services, we actually shop the market and find out what's best for your clients. And then of course we do that at no cost. I wanted to piggyback a little bit on what Kamal had said. So this slide here, it's the times that we're having right now, it's crazy. But I'm sure we would all agree that we don't want to actually worry too much about the market and about what's going on right now. You gotta think of it from a long-term perspective and not from the short term of what we're going through right now. And a lot of people talk about timing the market, but I would kind of submit to you that it's not timing the market, it's time in the market. So the longer you're in the market, the better it is. And this kind of just shows, and if you look here at the orange dot, it represents the bottom. Now, we don't know if we're at the bottom yet, and it doesn't really matter if we're at the bottom yet or not. It matters that this is where we're going, the long-term valuation, and where we're going hasn't changed. The only thing that has changed is where we're starting from. So you have amazing stocks and companies and funds available to you right now, and they're on sale. So your strategies haven't changed because your long term is still where it is. Does this make sense? talking about timing the market. So basically, this kind of talks about if you were to try to time the market and jump in when you think it's the right time. So if you missed 10 days by timing the market, you would essentially, oh, let me go back there. So this is $10,000 invested over 20 years. So at that, the 20 years, this is how much you would make if you had that $10,000. But if you tried to jump out of the market and out of the market and into the market, and you missed just 10 of the top trade days, you would essentially cut your returns in half. So I won't go through the rest of this for time, but it shows you that you really need to not think as much about emotionally investing and just hopefully rely on your financial advisor that you have. And I love that slide that Kamal put up there about should you check a second opinion or should you run from your financial advisor. That's awesome, and it is very true. It's very true. I'm not going to get into this. This is just kind of the GICs, and unfortunately a lot of people have their money in GICs, and a lot of people in times like this, they run to the GIC or they run to the T-bill. And I actually left out the next slide, but if you jump into T-bills or into GICs, you're going to take roughly 400 months to return your investment from what you're losing now. This is very elementary, a simple analogy, but I like to show it because it's the power of compounding. So $100 a month for 35 years. So from age 30 to age 65. So if you were making no money on it, that would be $42,000. 3% it would be $72,000, 6% $133,000, and 9% $258,000. So it matters, and I know it's emotional right now, and I know everybody, even myself included, I look at my investments more than I should. But we need to realize that now is the best time to get into the economy and into the market and to do your thing. And this just shows, again, at $200 a month for the same thing. Now, I'll show you a couple of funds at the end here, because I know some people are looking at that 9% and going, wow, that 9%, that's crazy. But it's not so crazy. This is one of my favorite ones here, and I apologize for the people that aren't 25 years old, but it's just showing you approximately what you have to start saving to get $1 million at age 65. And at 35, at 45, at 55, at 60, and then of course at 65. Now this does say it's too late, but at the end of the day, it's not necessarily too late, because when you're retired, you're not pulling out all of your money. Your money's still compounding, your money's still growing, and there's still conversations that can be had. Here's a couple of the funds that I was talking about. One of the dynamic, the funds that we deal with, and the global funds. So this one, 14% since 2013, and 12% since 2013, also September. So there is funds out there, and these are just a snapshot of two that I had just had in the slides. How much time do I got? Hold on. So, it's kind of going a little off track here, but the reason I like a lot of these fund managers, and it kind of shows it down here, is all these fund managers, they have their own money invested. So what they're going to be doing for you, for your funds, for your money, they're going to be doing for their own too. So by having their vested interest, I feel a lot more safe and a lot more secure that if they're losing their money, or they're not going to lose their money. Investing in a corporation. So basically what we've talked about here can work personally, and it can work in your business too. So there's lots of different ways you can invest. I wanted to just briefly touch on the difference between mutual funds and segregated funds. So with segregated funds, there's more guarantees. So you get more protection and you're safeguarding your money. No fees payable to death, so you're bypassing probate. And, you know, well, like the quote here says, you know, a big part of financial freedom is having your heart and your mind free from worries about the what ifs of life. And right now, there's a lot of people that are extremely nervous about their money, and having, you know, guarantees is just, you know, one more peace of mind. Of course, like I just said, it's also faster payments to the beneficiaries, and you know, bypassing probate and privacy. I did not know about this one before, but with your will, when that stuff goes to your will, that stuff, you know, somebody can go to the court and they can actually bring that up. So when you have segregated funds, it goes directly to their beneficiary, and that is not, somebody can't access that through the court system. I don't know if that's important to some people, but a lot of businesses, it's very, very important. And then, of course, creditor protection. If you are falling on hard times, especially now, you have the peace of mind and the comfort of knowing that, you know, whatever you have left to your beneficiaries is actually going to go to your beneficiaries, not going to go to your estate, and then have the chance for creditors to take it before anything gets to your actual family. A plug, of course. There's a lot of things that a lot of people are doing now, and you know, checking out your portfolio and seeing where you can go or what you can do never hurts, and it's complimentary to get that financial needs analysis. I wanted to show one more thing here. Well, I got some time. Yeah, a couple minutes. And I apologize for the technical difficulties. I don't know what is going on with my screen. Here's a simple analogy, and I'm not sure how many people have seen this, but something called dollar cost averaging. Dollar cost averaging is absolutely amazing. So we all obviously came out of the bull market. We're basically in a V market right now. So just basically a 2-minute analogy here. So which market would you like to invest in? And I'm just going to speak for everybody. Most people talk about the bull market because most people don't necessarily understand the principles behind investing. But if we look down here, as dollar cost averaging, it's basically what you're doing is you're buying into it monthly. So as the price goes up, you're buying it. As the price goes down, you're buying it. But essentially what you're doing is you're averaging your dollars out over time. So if we took a look at this, how dollar cost averaging can help, let's say you're, you know, the $100 investment and you're buying it at $10, so you purchase 10 units. And I'll just fast forward here. So basically your book value, $1,200, your market value is $1,300, and your profit is $152. But with the dollar cost averaging, because you're buying it as the price is dropping, here, price is continually going up. As you're buying it when the price goes down, and then the price goes back up again, you're basically 4 times your profit that you would have in a regular bull market or a regular volatile market. So when people say, you know, now is the best time to buy, it truly is the best time to buy. There is amazing companies right now that are on sale. They went down in price, but just on paper, they still have amazing value. So that's pretty much all I had to do, and I will turn it back over to Mitch.
Komal, Jeff, thank you for sharing what is a fire hose of information. So to start with, while I have both of you here right now, we have a couple minutes left and we'll be able to open up for some questions from those that have come to join us. If you had to start today where you are, and again, little difference in age, little difference in position or station, what would you do? What would be the very first act? And Komal, will go to you. What would be the very first thing you would do to start to protect yourself and ultimately plan or lead yourself towards having something better than where you're sitting right now?
Thank you, Mitch, for this question. And I'm super grateful you brought that question up because I'm also a growing entrepreneur, and I have recently started my practice 2.5 years. So how can I feel confident in terms of what I am doing? So if my simple analogy is, if you don't have the basics set up today, when you have less money, and you're not able to manage less money at this moment, when the money will start flowing, you won't be able to handle that in any way. So plugging yourself, like finding the small little pockets where you can start plugging your money aside, is the key strategy at this moment. Doesn't matter. Let's just say, for example, last month it was my lowest month, so I'm going to share my salary with my payment with you. I made 100 and what, not 100 but $1,900, right? That was my lowest month that I made, $1,900. What I did, I put 10% aside. So I'm doing, just like Jeff said, I'm doing dollar cost averaging. I'm buying small. I didn't stop my payment because I think I have enough capacity or capability in me that at least if I do 30-day work, I will be able to at least close one business at this point of time. So I'm not worried about that thing. But I plug in myself into percentages, like 10% is going towards my saving and my investment planning. The next 20% of my income is going towards my debt payments. If I have credit card right now, like, because I was supposed to go to India, so I plug in some of the money into my credit card. So now I allocated the 20% of my income towards the debt payments. And I'm living on a lifestyle of the 70%. Initially, when I started my practice, I started with 90-10. I was spending 90% of my income, but at least I was saving 10% of that. So right now, the strategy should be that even in that 10% of your 10% of your saving, the 10% of that 10% should be invested in buying silver or gold right now. Because there is an inverse relationship between both market, the stock market and the precious metal market. So when the market is going down, the precious metal market is going up, right? So this is the time to invest in the stock market. When the market is going up, when the stock market goes up, the precious metal market goes down. At that point of time, instead of investing in the stock market, you should be invested in the precious gold market because it's an insurance for your money. It will all balance it out in the long term when you're looking in the long-term perspective. And I know that I have started my small little basics of like plugging the money here and there, not based on the amount, but on the percentages. That gives me enough security in my own self that I know when the big money comes in or the big transaction happens, when the money starts flowing, which will start flowing in next 3 to 6 months because the market has to boom back, has to recover back. So the businesses will start becoming more active and start engaging more people, and the life cycle will start back to normal. At that point of time, am I ready to receive the monies? I will be. So that's my strategy in terms of feeling myself confident. Doesn't matter if I have small money right now, if I have less income or no income, but I know I have plugged in my basics in a way that I don't have to worry about my personal. I negotiated all my bills. I'm left with like 2 or 3 bills now that I need to negotiate with the providers, right? I sat down with myself to reevaluate what expenses I have made, what expenses that I have now, and how much expenses that I can bring it down so that I'm cutting down mercilessly on the things that I don't need it at the moment, but still keeping my luxuries in terms of going for Starbucks coffee once in a while, or like ordering a takeout food from outside and making sure that I'm feeling appreciated of the things that I'm doing. So these are the things that help as a small business owner to just keep yourself motivated towards moving forward and focus on your business as well as working in your business. Like it should be like 50-50 percentage right now, that you should be focusing 50% of your time on the business to see where you want to land your business in next 6 months to next 2 to 3 years or 5 years or 10 years, and 50% should be working in your business to make sure that it's sustainable. You're helping the people who are responsible to you, or you're able to sustain the staff that you already have. So that's how I'm working. I still have an assistant, so I hope I can maintain her for next 3 months, which are the most crucial months for every business owner or every person in existence right now. But I'm just sliding. That's
Thanks,
how I'm
Kamal.
working.
Thanks, Kamal.
Yeah, you're
Jeff,
welcome.
your thoughts? Where would you start right now if you had to?
Well, I'd like to echo on a lot of stuff that Kamal said, because I have called some of our product providers too, not product providers, sort of negotiated like even the cell phone. You got that for $40 a month, and it's just crazy. You know, if you can get all these bills down now, how long have they been sticking it to us? So one of the big things, and you know, I echo exactly what Kamal said, is paying yourself first. Find out what you can put away now and putting it away now, not afterwards, because we can all spend it. You know, my wife has a bunch of direct withdrawals coming out of the bank account all the time. I don't know where they go, but they're directly coming out of the accounts. And what I was thinking about the other day is there's a lot of money right now that I'm saving that we're not eating out. Well, we weren't eating out very much before either, or on fuel. I mean, how much fuel are you not spending right now? Take that amount that you would have spent anyway and put that money away, because it's not money that you've saved. It's money to invest. I mean, saving doesn't make you money. So just by taking the money that you were already spending before and redirecting it before you can, I guess, waste it. And that's really where I would start. That's pretty much it. And of course, dollar cost averaging. I mean, if you're not putting money into an investment, into retirement monthly, then you're doing yourself a disservice, because it's compounding. Like we said, it's not timing the market, it's time in the market. And the longer you can keep that money in the market, the better you're going to do.
Jeff, thank you very much. If I can summarize briefly before we sign off for the day as well, and to hear some of what we heard today, these are the tools and implementation, the things that you have to look at that are cornerstones or foundational. In some respects, some of us on this call might be hearing this for the first time, or you might be hearing it repetitively. In other words, we've heard this same thing over and over again repeatedly, and we're thinking, okay, well, what is there new? There's nothing new. It is a fundamental process. It is a simple tool base. Start with where your money is and where it's going. Look to control it, understand it better. Make savings and cost exchanges, cost differences, or cost decisions to the best of your ability. Find a rule of thumb for setting aside a certain portion of the money that you earn on a regular basis, and put that in a spot where it's going to be working towards your medium and your long-term goals and range. Have a plan for those expenditures and even some of the fun that you're going to want to have in the near future, longer-term future as well. Plan for that. And lastly, be very conscientious and cautious about what you do with your money. It is precious. As we can see right now, yes, our world revolves around how much money we've got in the bank, or how much we have in our wallet, or how much we keep in an envelope, or how much we bury under our mattress. But the reality is that money is precious because it maintains our families, our lifestyle, and keeps us whole. So when something threatens that financial security, it pays to start today. It might be in a very terrible time economically, but there's also advantages to be had because of it. So if you can find whatever it is that you have and invest towards making you now and in the future stronger because of it, when the next challenge comes to us economically, socially, etc., we're going to have the ability to protect ourselves far better and to be better prepared to deal with it. Jeff and Kamal, thank you for sharing your insights, suggestions, education, and resources with everybody that came and joined us. For the people that were on here, if you're looking to, please reach out to Jeff and Kamal at your leisure. Ask any questions you want. Of course, I will be at your leisure to help you with anything that I can. And watch for the replay of this webinar moving forward in the future, and the next seminar series in a Cyndicate Talks as we provide more business education. Ladies and gentlemen, have a fantastic afternoon. It has been a pleasure seeing you all, and have a great day.